Hello and welcome to Business on the Wire. The Q3 GDP figures are out. They're bang in line with the Reuters poll estimate of 4.7%, and the initial reaction across most television channels and business houses seems to be it's a good number and it's time for the green shoots theory to actually come into place. This is a bit like saying, and there is no bad intent over here, but this is a bit like saying yesterday you didn't have a fever, but today you need an operation. This is a retrospective figure. I think it's also not taking into account at all the completely changed scenario for Q4, both globally and the ramifications of that locally. But let me walk you through some of the key details of that Q3 GDP figure before we talk about the minutiae of it. The figure itself stands at 4.7%. The GVA growth stands at 4.5%. For the full year, the estimate now stands unchanged at 5%. So that means for FY20, the GDP estimate is being held at 5%. Some of the positives: farm sector growth has actually improved for this quarter at 3.5% versus 2.9%. Bear in mind, this was in the figures and factored in because of the fact that farm sector output or crop output was expected to improve. Ditto for the mining sector numbers. Mining sectors come in at 3.2% versus a negative tick of over 4%. Again, improving weather conditions did expectedly hope to see some kind of spike or spurt in mining sector numbers, and that has indeed borne through. Core industries growth as well came out shortly before the GDP figure, and I want to quickly walk you through that. That's actually static for January at 2.2% versus 2.1%. These are month-on-month figures, and many areas like fertilizers, steel output growth are actually seeing a slippage. Natural gas and oil output remain in the negative, one's at minus 5% and one's at minus 9%. Just swinging back to the GDP figures now, there's a few other categories which don't have such positive numbers for themselves. For example, power, gas and water growth are actually at minus 0.7% versus 9.5% year on year. This is a core indicator of what's actually happening on the ground in terms of industries and the usage of all these core verticals. Just to repeat that figure for you, minus 0.7% for the quarter gone by for power, gas and water growth. Finance and realty has improved a bit at 7.3%. Public administration and defense, again for this quarter specifically, government spending was intended to get boosted and see a bit of a bump up. That's come through. So PABAD and defense have come in at 9.7% versus 8.1% year on year. What is interesting in these figures is that investment for Q2 and for Q3 has actually contracted. So that's come in at a negative tick in terms of private investment growth, and manufacturing is actually down at minus 0.2% versus 5.2%. I know I'm throwing a lot of numbers in here, but the core of what I'm saying is that the data still remains quite muddled. I wouldn't buy into a green shoots theory yet. The latest numbers that we have from December, whether it is in terms of consumer spend or in terms of what's happening in the auto sector or indeed some of the core industry growth that I just walked through, don't paint as rosy a picture as is expected. There is a bigger problem that's happening for these numbers and indeed for the economy in general. The fiscal deficit numbers that came in along with the GDP figures look quite disturbing. April to Jan fiscal deficit stands at 9.85 lakh crores. To put that in perspective for you, this is at close to 130% of the revised FY20 aim. So things are expanding larger and larger, and that balloon is just getting bigger for the fiscal deficit even as we celebrate a 4.7% tick on the GDP figure. The Jan fiscal deficit is at 53,700 crores. The capital spend as well has not moved too much, and the revenue deficit now stands at 43,000 crores or more than that versus 54,000 crores year on year. That's the GDP figure. I think a lot of economists have already put in the strong warning which should be taken on board of what happens to Q4 and more importantly what happens going ahead in FY21. The one huge boulder that I think this economy and most economies across the world did not see coming was the coronavirus and the expectation of how much that's going to wipe off. Some estimates actually stand at $1 trillion in terms of wiping off that much wealth globally. There have been growth predictions that are already out. For the US, for example, it is the weakest growth prediction since 2009, just to put into perspective the global framework of where we're standing at and what happens going ahead. I think I would still put more stock on what's happening on some of those key data points that we track month on month, which include what's happening in the automobile sector, which include what's happening in terms of consumer spending, and of course what's happening for industry per se. Remember, this is also a quarter where the corporate tax rate cut should have been digested and a great amount of largesse was expected from the corporate sector. I'm not sure that I see that either in terms of the growth for the power, gas and water. I certainly don't see that in terms of the fact that investment has contracted. That's part one of what the context is at this point, which is a retrospective number which looks a little bit better than people expected at 4.7%. The bigger problem is the problem that the stock market has been facing for many days now. There was this confusion about whether the stock market is forward looking or backward looking and where it was getting all that enthusiasm from. Now we know where it's getting the fear from. The fear of global contagion is large. The fear of global contagion is also a problem because on this one, the stock market, much like many other global stock markets, literally does not have a clue. There is no sense of what the impact of the damage might be from coronavirus. There is no sense of how funds may choose to participate or not in emerging markets like ours. And I don't think the government or the industry has a handle on what kind of follow through or flow through is going to happen in terms of whether or not this intermediate product availability is a situation that India Inc. can navigate its way through. I know there's been a lot of talk about how Indian counterparts will make up for the stop gaps or will provide a stopgap for what's missing from the Chinese market, but I think that's wishful thinking. I just want to bring home a couple of points about the equity market. The weekly loss for the Nifty and Sensex stands at 10%. In 5 days, that's the amount they've lost. This is the worst week in 10 years, in a decade, that the market has seen. The Nifty actually closed down 500 points for the week. I mean, when was the last time you saw that? It was around the global financial crisis. There is going to be, and I think the market has sort of sussed that, even as you look at what's happening with the March series data, there is not going to be any V-shaped recovery from this coronavirus issue. It's not something that we can all snap our fingers, put behind us and move on with. These are weak growth predictions. These are weak stock market predictions, and I think that's going to begin to weigh on the market, not least because of what happened in the currency market as well. Again, I want to bring home the fact that over there, the rupee closed at 72.18. It is a multi-month low. It's the biggest single session fall since November, early November, I think. I think it's also facile to start comparing our market with global markets and say, oh look, but the Dow fell this much, and oh look, but the Kospi fell this much. Frankly, at this point, we don't have a single clue, like I said, on how bad the impact is going to be. It's also a time where we need to overperform rather than underperform or just about hit a benchmark. So I'm not sure if 4.7 growth is enough for people to sit up and take notice. I think once the whole canvas of corporate earnings is digested, there will be a lot of question marks about the huge premium this market was enjoying and whether at a single stock level, I'm not talking about the market as an overall, but at a single stock level, do those stocks deserve the kind of premium that they are enjoying at this point? Frankly, with the 4.7 mark, I would say that there are many question marks going ahead. We are certainly not on a clear stretch yet. It's not looking like a long and straight highway where the market and the economy is now zooming back to recovery. If anything, the start of this year has brought on much bigger burdens on our economy and our equity market, some of which we certainly don't know our way around in terms of navigating. I'll leave you with one interesting point, which is that it's ironic that after giving the GDP data, we need for government officials to come out and say this is completely legitimate data and we stand by it and it's all verified and okay. I think it's a sign of the lack of trust, frankly, that has developed in many of these numbers. And I think over the next couple of days, a lot of the numbers will be sort of seen threadbare and torn threadbare just to figure out what it is exactly that is the fabric of this growth recovery that people are talking about. For now, I would hold my horsepower. I would also hold the hurrahs.
To receive instant updates on all videos from The Wire, click the subscribe button and hit the bell icon. Pay to support independent journalism. Click the link in the description and choose the amount you want to pay.